morning, ladies and gentlemen. Welcome. First of all, thank you for inviting me and S&P Global to speak this morning. It's the opening speech, and opening it is. I see there are still a number of people coming in, which is good. Let me start straight away. We have heard a lot of bad news about the chemical industry. There's been a lot of skepticism, a lot of pessimism, and in some respect, quite rightly so. So today I wanted to offer a slightly different perspective. We have some key messages. Some of the messages are tough. It's a tough time for the chemical industry in Europe and worldwide. But the point we're going to make is that there are a number of caveats, a number of however, and although there are certainly a lot of uncertainty, particularly in terms of macro views, the reality is that when you look very carefully at the chemical industry, some of the issues and some of the opportunities go much deeper than simply what's happening with tariff in the last few years. And in reality, if you lift your gaze, if you look beyond the now and the next month and the next year, you realize that the chemical industry has some fantastic opportunities, and the underlying raison d'etre for the chemical industry is still very solid. We'll go a little bit on that, and then we'll end up talking just a little bit about legislation and policy, which I think will be a fitting introduction to then the next speaker on CBAM. We like to use data when we can. So let me first talk a little bit and quantify some of the problems. I'm not even trying to describe or forecast what's going to happen with the U.S. president, with tariffs and whether they're on, they're off. But the reality is that there's a lot of uncertainty, and certainly there's a lot of geopolitical uncertainty and trade uncertainty at global level. So just one way of looking at that is just a very simple chart. This is this is the proportion of imported goods, and this is from the U.S. Bureau in various countries and in various sectors. I mean, we highlighted chemicals in Europe. As you can see, is very big. In fact, I mean, without having to do a lot of complex analysis, you can just very quickly see that when you look at Europe, the big bars are aerospace and defense, chemicals, and of course, pharmaceuticals. I think it's interesting enough that when you look at actually China, as a proportion, is actually not very big for the Americans. But of course, that's not the fundamental problem. So let's go straight into a bit of China and a bit of chemicals. Again, lots of numbers. We don't need to go through all of that. But we, as a global agency and as many other people, are obviously trying to develop a number of scenarios on what could happen in China and what could not happen. It's always good to start from some solid stuff. So, if you take, for instance, ethane and propane, China is a very large buyer of both feedstock. So the question is, okay, so in a situation where for China is very difficult to get hold of some of the feedstock, what do you do? So, you build this. So obviously you can import from some countries. There's some cargo swaps that you can do within region, outside region. We design various scenarios, and whatever you do, there's still a big shortfall. Yes, there are alternatives. Obviously, you can move some of the production to naphtha, but there's a limit. First of all, there's a physical limit to how much naphtha capacity there is in crackers. But also, remember, naphtha and chemicals is competing with other outlets, primarily fuels. So in reality, the net effect of this would be a repercussion, a ripple effect on other countries. Now, other countries, such as Europe, for instance, these two charts are really about sentiments rather than hard data. But I think they tell an interesting story. We picked some of the key underlying market for chemical companies in Europe, and as you can see, well, obviously, as you would expect, there was a big drop, a few years ago. Then some of them recovered, some of them not. But generally speaking, there's been a little drop here, and we could, but we will not, go line by line and see how each of these indicators have changed. But I would just point out to some of them. So. A surprising one, for instance, is the order books level that, in fact, has gone up. And this is because, in reality, these dynamics are quite complex. It's not just a case of going down. People are preparing, people are stocking up, some people are depleting stocks. The fundamental point here is that what we have determined is that the actual biggest effect, negative effect, is not so much on individual chemicals or individual tariff, but is the general decrease in GDP and the general decrease in demand attended to that, which is why we have revised our GDP forecast a number of times now. But that said, when you talk about GDP, you want to be quite careful of which countries you pick, because this is the first big however. So yes, we revised the GDP. The GDP is gone, forecast growth has gone down. But look at Europe. I mean, Europe is a very interesting case, because if you compare the western part of Europe with the eastern part of Europe, you see that the trend may be similar, but the absolute value are very different. And frankly, when it comes to GDP, I would rather be on the eastern part of Europe than on the western part. So we picked two cases, fairly extreme, if you want. One is the UK, not quite, not more a EU 27, but still very much a European countries. As you can see, the effect on GDP is, it's not very good, but even the UK, the GDP is trending up. And then there's the case of Poland. Poland is an interesting case. I have to say I had to recheck the 2023 because it seems so low, but apparently that is the drop that Poland experienced in 2023, clearly subsequent to the COVID effect. But you see, these are good numbers. So I think we need to be careful when we talk about depressing demand and depressing GDP, because when it comes to Poland, yes, it may be depressed, but the trend is still good and the numbers are still good. I think when it comes specifically to the chemical industry, and we talk about Europe, that's the other point. We are here. Okay, so yeah, there's a little bit of a dip, but let's be honest. The fundamental problem with the chemical industry in Europe predates the tariff and the uncertainty of the last few months, or the last China problems, or the last US administration. And you can see that essentially if you index, say, 2021 to 100, and then you start tracking some of these sectors, as you can see, by and large, they are all decreasing in terms of. I don't think any one of these is a surprise. I think the surprise is perhaps the amount to decrease rather than the trend. as you would expect, basic chemicals is the one that's being hard hit. And it's the lower one. Again, some of the others, plastic packaging is doing not too bad for various reasons that we might explore. But generally speaking, the point here is that it would be misleading to think of this demand problem as a China or US or tariff problem at all. And if you look at other indicators, it's pretty much the same evidence and the same story. What we've done here, we've taken, we're S&P, so we have taken the S&P 500 as a reference for the last 12 months. And then another index, which is less famous than the S&P 500, but in chemicals is probably more important, which is the Chemical Week 75. So these tracks the top 75 chemical company, chemical stocks. I mean, as they say, the numbers speak by themselves. So, the one in yellow is doing okay. Obviously, it's dipping, etc. Well, the one in green is the chemical industry. I think this summarizes pretty much what the market sentiment in terms of financial market is. The chart on the right is a bit less easy to read, but is an interesting one. Is about outlook and sentiment. So this is based on hundreds and hundreds of questions about what people, how confident they are about the future in terms of positive and negative. And if you look at oil and gas, well, first of all, there's a big spread between positive and negative bias. But the interesting thing is that, and sorry, you cannot see it very well, but there's a little black triangle here. So this is the net opinion a year ago. So although there's a large spread, interestingly enough, a year ago, people were pretty confident about the future and the potential recovery of the oil sector and the chemical sector. If you move to today, the red one is shifted in the other direction. So a number of indicators, they all pointing pretty much in the same direction. It says this is not a new problem. So what is the problem? Well, the fundamental problem is this. Globally, we have been in overcapacity for a number of years. We use this chart quite a lot. As you can see, the gray bit in the background describes demands, and capacity is described as stacked bars. I'm not going to go through each of them, but I will just point out a couple of things. First of all, the red one is China. Again, no surprises there. China has been building capacity for many years. I think the surprise is another one, which is China is not stopping building capacity. So that's an important point, because although the capacity build, as you can see in red, is decreasing, is not stopping. And that means that a lot of other regions, in particular Europe, will have to rationalize their capacity, starting from crackers, but going into chemicals. There are good reasons to do that, not just the overcapacity. A quick start on, let's take crackers, ethylene capacity. If you look at the average size of a cracker in Europe, is below the global average. And same thing for age. So it would be an exaggeration to say that all the crackers are old and all the crackers are small. But certainly the average isn't very good. And remember, we're not even comparing here with world scale, because world scale would be 1 million plus. So this bar will look really bad. So what's happening is of course this. Again, I'm not going to pick any individual companies or any individual point, but I think we can all read the news, we can all, in some cases, experience the news, and there have been a number of closures and a number of announced closures. The educated opinion of S&P is that we're not done yet. There will be almost certainly more. This is not because we have a crystal ball and we can see the future, but it's simply a calculation of how much overcapacity still there is in the system in Europe. I mean, for those that will receive the documentation and need to see the chart, just a clarification. Most of this is obvious. These bar new projects. There are in particular two projects. One is the INEOS project one, and the other one is the Olen Olefin 3. Without going into the details, there is clearly some uncertainty to the final operating capacity of these units. So rather than trying to guess, we just graded the bar, but we wanted to make sure that it was part of the picture. So far, the picture is really bad. I wanted to change gear now a little bit and change completely the perspective. This is a Sankei chart, if I can use it, that describes the share of energy that goes into chemicals. As you can see, it's not very big. If you go ahead to 2050, all of a sudden, this flow becomes much bigger. Well, first of all, as you will have noticed, this is a very long chart to explain, but as you will have noticed, obviously the relative importance of the sources of energy and sources of raw material changes. So in 2050, obviously natural gas is higher than oil, nuclear has become somewhat more important, biomass, etc. But the point to notice is that the flows into chemicals and plastics has not gone down. In fact, on the contrary, has gone up. There is a very important point here. Even when you factor in very important trend, of course, which is the penetration of biorenewable and non-virgin material. Even when you factor that, and you take, for instance, the polyolefins, or you can PET will be a little bit better, but we're still talking of 10, 12% penetration. So the fundamental point here is that we all talk about peak oil. There is not such a thing as peak polymers or peak chemicals. Every trend's long-term forecast that we have of chemicals as a whole show an increase. If you project it between now and 2050, the overall demand and production of chemicals is always up. There is a big caveat, though, which is the overall social license to operate. I'm not going to spend a long time on the background on net zero. We're all very aware of the climate change imperatives. The point I want to make is that in most of our scenarios, not all, we take net zero at some point in the future as a given. So on that basis, there is clearly an absolute need for the chemical industry to reach net zero. The good news is that there's no shortage of ways of doing that. Again, I will spare you. I will not go through each single technology and each single way. But it's very clear. There are many different ways. You can work on the upstream, you can work on the downstream, you can electrify, you can decarbonize. So the options are really many, many options. Therein lies part of the problem. The first problem is that it is an incredibly complex system to optimize. Even without going into technology themselves, believe you me, because in S&P we do this modeling quite a lot. Trying to decide for a single refinery, for a single chemical unit, for a system of units, what is the best combination of this technology, given a certain profitability target and a set of legislatory constraints, is incredibly difficult. In this case, the additional challenge is technology. We could argue for many hours on where these different technologies and solutions lie on our maturity chart. But there's little question that technologies such as onshore wind and solar are essentially mature and at scale. That doesn't mean they're not growing, they're still growing, but there isn't a lot of uncertainty on the technology, so they're fairly easy to model. As you move to the other end, you get into things like fusion, nuclear fusion, direct. So these are potentially game changers, but the case, the technology, the scale is still 12. There are all sorts of intermediate points, and one can argue, and some people do argue, where this sits, whether CCUS is already mature or whether it's not. But technology uncertainty is the second biggest problem. Interestingly enough, though, what drives decision and investment is not so much technology maturity, but is good old legislation. Some of you may have seen this type of chart before, because in S&P we've been using it a number of times. But let me explain it very briefly. We mapped legislation and policies on two dimensions. One is whether they rely on primarily on incentives, so the carrots, or primarily on, let's say, a hard measure, so the sticks. And the other dimension is whether they typically focus at national level or whether they tend to have a global or international valence. So, classic example. Carbon taxation. Carbon taxation is the quintessential stick. There's, if you happen to be in a certain country, and that country will have a legislation process that decides a certain value, and you just take it. At the other extreme, you have perhaps the very famous IRA, the Inflation Reduction Act in the US. Now, interestingly, there are now a number of questions on how effective and how impactful the IRA is going to be. But as a model, it's still very powerful. And then you can see all the intermediate things. We personally think that there is a lot of mileage, a lot of future into voluntary carbon market. And of course, one of the stars of our firmament is the topic of the next session, which is CBAM, which sits there. I think the fundamental message here is not, whether a particular policy sits on the right or on the left. The fundamental message is what drives investment and policies, ultimately profitability in many of the countries, particularly if you're sitting on the right-hand side, is more understanding and predicting the impact of legislation and policy, even more than technology. With that said, let me just recap some of the points and make perhaps some conclusive remarks. It is certainly a very difficult situation to read, but I've been in the chemical industry for a while, and every sort of 7 to 12 years there are a number of difficult situations to read. This is perhaps one of the worst crises, but it's a crisis that in a way, we saw coming, and the market and the industry has mechanisms, painful as they might be, to take care of it. So some of the conversation I heard yesterday, and some of the work that we ourselves did with the chemical association around the world, in the UK, with CEFIC, sometimes people ask the question, is there a future for the chemical industry? We personally think that question is almost meaningless. The answer is, of course, but the real question is, what type of industry, what form does it take? And we are convinced that to the extent that people can grasp the technology and the legislation, there's going to be a very thriving chemical industry because the fundamentals are so strong. Let me close here. There are 3 minutes to go. If anyone has questions or comments, I'll be very happy to take them. It's not very easy to see you either. Yes, please.
Thank you so much for your very powerful and convincing presentation. I have a question for you. You show in the previous slide that we have both wind and solar energy at maturity level, full maturity level, but in my lifetime, I know that not even, let's say, 8 years ago, we had still doubts as to whether we would have been at a production scale that would have been enough for this green transition of which we were starting to talk. And I have the impression that what has really made the difference has been indeed the determination with which the European Union has launched its climate neutrality goal. As just in 2019, we are talking really just a few years ago, how do you see from a Standard & Poor's perspective the impact of that strong political commitment and determination versus the, becoming at scale in terms of producing the renewable energy we need?
Thank you. It's a good question. I think the recipe that got us so far in solar and wind is not easy to reproduce because, as you remember, a few years ago, it took some countries like Germany and other countries to really believe into what at the time was a technology which, frankly, in terms of cost, was not very efficient. But the idea is that, with time and scale up, things would improve. And they did. I think when it comes to, but without belittling the technology, it is a relatively simple technology compared, for instance, to, say, carbon capture. Because carbon capture, apart from the technological challenge, has a lot of logistical challenge. You need to find the cavern, you need to, the logistics. So I think that it will take an enormous political will, and not just by one country alone, to make some of those things happen, even beside the technology part. Okay. If there are no more questions, thank you very much for your attention.